Bank of Uganda Governor Tumsime Mtebile says they are holding still the benchmark lending rate, citing a gradual rise in core inflation over the next 12 months. However, the central bank forecasts that the falling food prices and global oil prices would soften inflationary pressures.
Current low levels of inflation are largely driven by the decline in food prices in 2014 due to a good domestic harvest, lower global inflation, and the decline in crude oil prices.
The Bank of Uganda decision to leave rates unchanged was widely expected by the markets, given this year's projected growth standing between 5 and 6% in the fiscal year ending June 2015.
There were very little signs for Bank of Uganda to make any changes. As I've said, inflation has been coming down. We are at 1.3%. In terms of the effect to business, I think we've seen credit growth in the economy. We expect this to continue in the current environment.
The central bank says this growth will also be supported by increased public spending. However, the bank argues that this growth outlook is subject to future risks.
Key risks for the economy include a widening trade deficit, the possibility that investments in the oil sector will be delayed given the fall in global oil prices.
According to the central bank, possible volatility in global financial markets and a rise in domestic demand beyond the present projections could also pose a challenge. The global strength of the dollar has also triggered a scramble, with some commercial banks taking advantage to build hard currency positions. This has resulted in a sharp depreciation of the Uganda shilling, but analysts say this may be good for the country. The Uganda shilling has lost 12% against the dollar year on year.
We did see some reprieve, and we did see some good flows coming from the export side. These are the coffee, the fish exporters. We did see them getting a good export inflows and export proceeds from the depreciation of the currency. So it's a bit of a balanced game.
Market analysts say the depreciation has hit hard at importers, but argue that this will improve competitiveness locally and automatically stabilize the exchange rate. Michael Baleke, CCTV, Kampala.